Do you think they're doing business as a sole proprietorship, or do you think they might be doing business as a real, true blue, formalized, best form of running your business called a corporation? I'd say that probably is the good thing. And the bad thing is that maybe there's assets inside the corporation. Now, there's one that you haven't talked about yet. Why would we have a problem with having assets in a corporation? Now, most of the corporations we're going to be talking about today, pretty much exclusively, is going to be as it relates to you. Private, closely held corporations. Private. Now, when it comes to private corporations, not public, this kind of connotates maybe a big public utility or something. But if it's a private corporation or a private business, I am going to tell you something right up front, which might be a negative, and that is you probably don't want to hold assets in the corporation. And the reason is, and I'm going to tell you this right up front, then we'll prove out the point later. Corporations may be the greatest tax shelter in the world, but they make lousy lawsuit protection devices. If this business, if you have a lot of equity in that business, let's say that business is done so well, that property is completely paid for. It owns no mortgage. What would we say on the surface? Whoa, that's great. Congratulations, you've done a good thing. Well, that's great unless the mother of all lawsuits comes down the pike. Let's say the mother of all lawsuits comes against this corporation, a judgment is made, and you discover that the judgment is about 10 times greater than what you had insurance for. Guess what the judge is going to do to come up with the difference between your insurance and what the judgment is? They will liquidate that building. That is exactly correct. The benefit of a corporation is that it does separate the lawsuit between the corporation and you personally. But when it comes to the assets inside of a corporation, we learned a long time ago that when we entered into a lawsuit epidemic in this country, some 25, 30 some odd years ago especially, we found out that lawsuit case after lawsuit case after lawsuit case was liquidating corporate assets by the droves. So the positive might be that this outfit has learned how to operate the business in the most efficient, most productive, best formality or best way that the code permits. But the negative of this might suggest that this company also owns all those assets, and maybe that's not so good. Okay, let's talk about that. When you go to the U.S. tax code, you're going to discover there's a part of the code that talks about how you and I will be taxed as individuals, and then there's a part of the code that talks about how you and I will be taxed as a business, and you will discover they are not created the same. They're as different as night and day. The number of ways that the IRS gives you and I to reduce our tax liability on our income tax return is pathetically small. And not only that, you actually start out underwater. The fact of the matter is that when you earn a wage, the very first thing you have to pay when you earn wages as an individual, the very first thing you have to pay is what? Is taxes, am I right? And not only that, but when you got your first job, did the employer who was hiring you stand up and say, yeah, don't you worry about that, we'll help you, we'll withhold it for you? And you know that by law, if you own your own business, you have to withhold those taxes and send it into the IRS, so you got no choice. That is not how businesses work, my friends. And when I tell you what I'm going to tell you, some people have said they've been in business for 40 years and never really thought about that as being true. Now, what I'm about to tell you may not be exactly 100% correct, but it's more correct than not, so I'm going to say it anyway. And here it is. Businesses don't operate on that same basis. You as an individual earn the money, pay taxes, and you spend what's left over. Businesses earn the money, spend it, and then pay taxes on what's left over. Did I say that right the first time? So, in other words, if you have your personal account and you earn it and you pay the taxes and you spend what's left over, but businesses get to earn it and then spend it and then you pay taxes on what's left over, how's that for a deal? Which one of those two systems do you like the best? Now, how many thinks that maybe I oversimplified the one over there on the right just a little bit? Okay, listen up. Let's put it another way, and then I'm going to let you think about this. What kinds of things does the IRS legally allow a business over here to earn money and spend it before it pays taxes? That's a valid question. But the fact of the matter is, it works so much better on this side than it does over on this side that even putting it this way is really more true than not, especially as it compares with you. Now, when you look at this, now I want to go back and tell you something that I found out in The Millionaire Next Door. Remember what we said earlier? We said that they found out that millionaires spend an inordinate amount of time learning how to make it so that they don't have to pay taxes. Remember that? And what happens is the conclusion is interesting. Not only did they learn how to not pay taxes, then it should not surprise you to learn that almost across the board they said that millionaires report themselves to the IRS as having their own business. I wonder why. Because they discovered that this is the greatest tax shelter in America. Why? Because Congress felt like that if you provide certain incentives, as we discovered yesterday, and you provide it to the types of organizations that make money in this country, that create jobs and hire people, it might make the economy better than if they tax them to death. So 88% of all the businesses in America have 25 employees or less. The government feels this strategy seems to do pretty well for America when they do that. So that's why there are a lot of benefits over here that you don't have over here. So that's what I'm trying to say. The millionaire next door says that people learn money, learn how to not pay taxes, and on the other side over here, they end up having their own business because of this. Now I want to go back to something I said earlier. I may have oversimplified this just a little bit, so let's pursue that. What kinds of things does the IRS allow a business to spend money on legally before it pays taxes? The answer to that first and foremost is, what form of business did you choose to go into? Now, I didn't say what kind of business. I don't know what kind of business you're in. I said, what form did you use? There is one at the top of the barrel and there's one at the bottom of the barrel. The one at the top of the barrel does a lot better job of taking advantage of the tax code than the one at the bottom of the barrel. Right? Now, what one do you think is at the bottom of the barrel? Sole proprietorships. Now, if you are in that category, don't feel bad. I'm not trying to make you feel stupid or dumb, because you're in good company. This is the number one most common form of business in America, is having sole proprietorships, because they're less expensive, they're less complicated, etc. But in the end analysis, there are so many financial potholes that are associated with a sole proprietorship that any person who's really seriously trying to be able to go into business should never use this form of business. One of them is the fact of what we've already alluded here. As a general rule, there are more alternatives for reducing taxes in a corporation than there is in a sole proprietorship. Now, in my own career, I've seen the difference between these two getting smaller and smaller and smaller. In other words, IRS is now making it more and more so that sole proprietorships don't have such a big disparity compared to corporations, and I've been able to see that getting smaller. But it's still not exactly the same. There are still advantages in being able to have the corporation you're not going to get as it relates to sole proprietorships, as it relates to taxes. But one of the other financial potholes has nothing to do with taxes. It has to do with everything with lawsuits. If you are a sole proprietorship, you are a dream come true when somebody wants to sue you and hold you into court, because when they get you there, they're going to prove to the judge that there is absolutely no legal delineation between you and your business and you. A lawsuit against you is against your business. A lawsuit against your business is against you. Do you see what I'm saying? So that's another reason why it's a financial pothole. Here's one that you might be interested in. I can't imagine anybody wanting to be a sole proprietorship when I tell you what the following information is. And the following information, I might have told you this yesterday. The following information came to us from the IRS's own website. If you get in and you actually do some digging, you're going to find out, and by the way, this statistic changes a little bit from year to year, but it hasn't been that long ago since I looked at it. And it says that if you are a sole proprietorship, how many more times are you likely to be audited by the IRS? 10 times is great. Sometimes it's 7, sometimes it's 8, sometimes it's 9, whatever. But anyway, somewhere between 7 and 10 times is great that you will be audited if you are a sole proprietorship compared to where if you are a corporation. And there's a reason for that. The reason is because the IRS has hired most all of their auditing agents to audit personal 1040 income tax returns. Where do you file a sole proprietorship with? On your 1040. It's part of your 1040. In other words, they have 10 times more agents out there that are authorized to audit a sole proprietorship. But when you are a corporation, they have a very special, higher level of cadre of agents that are required to audit corporations. So that's one of the reasons, if nothing else, that you have much less of a chance. And it even gets deeper. I happen to know for a fact, and you can ask Scott Estel this, for example, I happen to know for a fact that if you are an agent that's given the responsibility to audit a 1040 and a sole proprietorship, as a percentage of earned income, or excuse me, as a percentage of the profits, in your sole proprietorship, they are expected to extract a lot more money out of you than they are if you're a corporation. So they have to squeeze a lot more money out of you percentage-wise for what the amount of money you made in your sole proprietorship than they are required out of a corporation. You don't want a sole proprietorship, class, as a general rule. I think I don't need to beat that up. Okay, let's go back here. So now we have this other business. All right, let's talk about a couple of different things. Look here at the different rates. Now, let's say that you have a gross income of $100,000. That puts you basically in a 27% tax bracket. And that means that if you ended up paying taxes, all right, after everything, then you have $72,000 left over to spend. Is that correct? Okay. Now, what if you have expenses of $70,000? And when I say expenses, might some of those expenses be medical insurance plans? Of course, mortgages, that kind of thing. Why do you think I said medical insurance plan? Because in a few moments, I'm going to show you a huge difference between having your business pay more medical insurance premiums on you and giving it to you as a freebie as part of the benefit of having your business, or you earning a wage, paying taxes on it, and then going home and buying it on your own. That is one very big example. And the reason I like using that as an example is because what's the premium on your average medical insurance plan for you and your family? Would you agree it's hundreds of dollars every month? Thousands of dollars every year. You think it makes a big difference as to whether that premium is paid with after-tax dollars or before-tax dollars? Yes, it do, and I will tell you that the only thing that can make the difference between those two is if you have your own business, to have your business to buy the medical insurance plan, and if you don't, you have no choice. And if you want to know where I'm going with this, remember I told you that 88% of all the businesses in America have 25 employees or less. You remember that one? Okay, get this. 75% of that 88% pays no retirement plan or no medical insurance plan for them and their employees, for their employees. So that means that in those cases, those companies provide a wage and pay for those employees. They withhold taxes. They give them a check, and then the people go home, and with the after-tax dollars, if they can afford it, they buy a medical insurance plan on them and their families with what kinds of dollars? After-tax dollars. And that's only one example. So I'm trying to get you to think in terms of something here. I'm trying to get you to understand that the power of a business being the greatest tax shelter in America is because you want them to buy all of these things for you as a business expense of the corporation before you pay taxes as possible. And the more you do that, you'll discover why this is the greatest tax shelter in America. All right, this exact same example, watch over here. What if you could take $70,000 of those expenses in all different kinds of forms, including medical insurance, and have your business do it? And I'm sorry, it's only going to pay you a little bit less in salary now because it had to take out so much in business expenses. But now when you pay taxes, what you end up having is the same is the net income, net after taxes. You're going to end up with a whole lot more left over after taxes than you are if you don't do this. Now, I've tried to make this be kind of an oversimplified example, but are you getting the gist? See, you need to understand that the idea is to have a business that will provide you this much of a financial benefit to you and your family, but you only pay this much in taxes, as opposed to the other way around. And most Americans, because they don't understand that, they commit financial suicide. You're never going to get ahead if you do not figure out how to plug up the biggest black hole of all, and that's taxes. So, this little difference right here makes the difference when you do that. Common types of businesses. I don't care how many of these different things you come up with. This list could go all the way down into the floor and still have room for more to add on the list. You need to learn to become very creative as to what kinds of things would justify you setting up a business. If you go out and talk to the average person on the street, they will tell you that if you have a corporation, you must have a big company with lots of employees. Did we talk about that yesterday? How many... did you know that states actually allow you to set up a one-person corporation? Is that right? Okay. Is there a little bit something funny about that? I get people come up to me and say, can I talk to you about this corporation business? I mean, I thought you had to have a lot of employees. But can I ask you a question? You said that most states will allow you to have a one-person corporation? Yes. Don't corporations require that you have to have a board of directors meeting? Yes. Shareholders meeting? Yes. Does that mean that I have to go into a room all by myself and raise my hand and say, we resolve that the corporation is going to provide the following benefits to moi? The answer is yes. And then you're really going to go nuts. You're going to keep proof to show all your friends and family how schizophrenic you are, because you are going to keep the minutes of your meeting. Is that true? Yes. You know, the best person I ever heard sum that up for us was James Smith. He has a way of saying things just the way it is. I heard James, maybe somebody heard this, heard James Smith say, man, I love these one-person corporations. Man, he says, you know what? You can hold your meetings anywhere. He says, you can be in the shower and you can say, well, we're all here together, so let's have our meeting. Does that sound like a James Smith statement? All right. So the advantages of incorporating then is the ease of doing business, centralized management, and transferability of interest. And it does provide some limited liability between you and your corporation. These 4 steps I want to go through and discuss with you, because this is the absolute fundamental core as to why you want these businesses. And, of course, tax benefits, excuse me. All right, let's talk about ease of doing business. First of all, there is a structure that is in place that's allowed by each and every state in the United States of America. The corporate structure is allowed to exist in every single state because every single state has a state statute that allows it to exist. Every one of the entities that we talk about, limited liability companies, limited partnerships, corporations, they exist only because each state has state statutes that allow them to do that. But because every state has statutes that allows them to do that, does it make sense that maybe they're not all exactly the same? That is right. How many have heard about the fact that it might be a good idea to set up a corporation, for example, in Nevada and Delaware? Why is that? Yes, every state allows a corporation to exist, but in those 2 particular states, they have state statutes on the books that makes it extremely attractive to people who are trying to set up businesses, especially Delaware for publicly traded companies, and especially Nevada for private corporations. So that's something you need to understand. All states recognize the corporate structure. They do have a lot of things in common because they all follow the Model Corporation Act, but they are different. Perpetual in existence. What does that mean? That means that the gentleman that was around, or the ladies and gentlemen that were around when the Ford Motor Company was first incorporated, are no longer around, but the company they started still is. Sometimes you wonder if that's going to happen, but nonetheless it is. Does that make sense? So this can go on forever and ever and ever. What about a sole proprietorship? You really have to think about this for a minute, because it'll kind of screw your brain up if you try and figure it up too much. But you know what? If you and the business are the same and the business in you is the same, it really doesn't exist. It's just you. So when you die, I mean, that's the end of it, you know, in theory. It offers a degree of privacy for owners. Now, this is not one of the greatest reasons why we set up corporations, but it's surely a whole lot better than sole proprietorships. Now, because state statutes are different, some states allow a greater degree of anonymity than others. And that's one of the reasons, again, for using Nevada. Nevada makes it a little bit more difficult for somebody to figure out who really runs and manages or owns the corporation. So that depends on where you're at. It is, after all, a legal entity. What did we say that we're going to refer to entities as? Anything that requires a tax ID number. So do corporations require tax ID numbers? Yes, and when you do that, it becomes a legal entity under the law. That means that once you get your employer identification number, it is now totally separate from you. You is not the corporation, the company is not you. And one of the things that proves that out is the fact that corporation actually holds separate title to the property separate from you. I want to give you an example to show you how powerful this is. What if Rick, where's Rick? Rick today, for a few moments, is going to be the richest guy in this room. And the reason is because, of course, you get all the tax bill, right? No. All right, Rick is going to be a 100% owner of all the IBM shares. He went in, was able to buy all the IBM shares of IBM. Pretty good you're a pretty wealthy guy. Okay. But everybody knows who you are. I mean, you roll up in your Rolls Royce or your limo, and the security guards out in front practically bow down before you because you are it. I mean, you are the man, right? When you walk into the front doors of their corporate offices, after all, you own the company. Can you legally walk in and start taking out all of the furniture? Now, this is going to be an important question you asked her. All the furniture that's in the lobby area. I mean, you want to take it home for a party. You own the company. Everybody knows you own the company. You own it lock, stock, and barrel. You own the company. And so the security guards are just going to sit back and say, bless you, go right ahead. They're going to do that just because they don't want to lose their job. But technically speaking, is what he is doing illegal? Why is that? Because he doesn't own it, doesn't he? The owners don't own the property. You may own the company, but the company is what owns that property, not you. And in fact, to show you how important this is, think about it this way. If you have a corporation, is the corporation allowed to take tax deductions for the purchases of all that equipment? They depreciate it on their income tax returns, etc., right? So he just walks in and walks out with the stuff. Is that like fraud or embezzlement or something like that? Right. There is a big difference. When a corporation unloads its assets, is that a taxable event? Yes, it is. And so you got to understand, you is not the company, and the company is not you. And that's really good because of all the reasons why you want to do asset protection, but don't get confused. I always like to use the example that hasn't been that long ago where I walked into a little mom and pop gas station. And you could see that it was a family-run business. Mom and dad are back behind the cash register. And, little Susie comes walking in. Hi, Daddy, can I have $1? So, sure. So they walk over and they open up the cash register and pull the dollar out and give it. What kind of a business do you think they're running? Sounds like a sole proprietorship to me. Or if they're running a corporation, that's really a scary way to do business. Because little Susie's stealing the corporate funds. It's called embezzlement. Right. Nothing like teaching them early, So be very careful. Your rights as a person, you have freedom of speech, unlawful search and seizure. All of those things are benefited from that. So, therefore, there is a structure in place that's been around for well over 100 years on how to establish your business. It has a very formal, easy, straightforward, structured business. We also have a very structured, formal way of doing business as far as the management. Okay? First of all, we start off. Now, it might be better if you actually start thinking in terms of a regular big public business, because that might help you assimilate it down for your private use a little bit better. Is it true that even big corporations have board of directors? What is the mission of the board of directors? What is their purpose? What is their purpose? They are the ones that determine the vision of the company. They're the ones that are going to chart where the company is trying to go, what its goals and objectives are. They're the ones that write the mission statement. That's what the board of directors is for. Then the corporate officers comes in. Who hires the corporate officers? The board of directors. What is the mandate given to the corporate officers from the board of directors? To do what? To carry out the vision. The board of directors says, this is our purpose. This is where we're trying to go. This is our goals. This is our objectives. Now that we've created those goals and objectives, you, President, CEO, Chief Executive Officer, and so forth, your responsibility is to carry out those goals and report to us back as how you did it. And in America, it works out great because it really doesn't matter whether they carry it out or not. We're the only country in the world that will pay millions and millions and millions of dollars to corporate officers who totally miserably fail, and they get fired and they still walk away with great big billion-dollar bonuses. I'm telling you, it's really something. See how that works. I haven't quite figured that out yet, but nonetheless, Yeah, but in America, you can really screw up and it's still a very profitable business. You just have to get there in the first place, I guess. You got my point. I'm being a little cute here, but you got it. So they're running the day-to-day business. Then you get shareholders. Now this is really interesting because guess what the shareholders do? Because the shareholders own the corporation, it's one big cycle. Guess what they get to do collectively? They get to not only own the shares, but they get to elect who? The officer of the board of directors, and it starts all over again. Now, does it make sense, if you think about this in terms of large corporations, that a lot of the control that you might have over who's going to be the board of directors has a lot to do with how much of the shares you own? That's why if there gets to be differences of opinion as to where a company should go and what its vision and so forth should be, sometimes you get people like Warren Buffett that are big players. They may own such a large chunk of the shares that what they say goes, because their voting is so powerful. For every share they own, they get a voting privilege. Their voting power is so heavy that they can control the direction of the company, and they might even vote themselves in to be one on the board of directors. And so they should. If you get a great big company and you've invested out of your own personal pocket millions upon millions of dollars, wouldn't you think you want a little say as to what's going to happen in that company you got millions of dollars invested in? Okay, you got the point. So this is how that structure works. It's just one old big circle, round and round and round. It works pretty good. All right, transferability of interest. Now, one of the things that you have to look at here is, what if you're a sole proprietorship? What if you want to sell your business? How do you do that? Can you just go out and sell yourself? Remember, if you're a sole proprietorship, isn't the business you? And you is the business? Can you sell yourself? That went out with slavery. No. What really happens is you're basically telling someone else, well, I'll sell you the assets, and I might sell you the name, but because you can't really sell the company, you might come up with some sort of a private agreement that says, well, if I'm going to turn over all my clients to you and so forth, you know, they're going to continue to come to do business with you, and you have to give me a percentage of all of the business they do with you for the next 5 years or whatever. You might come up with some kind of an agreement. But basically speaking, you is the business, and the business is you, and you can't sell yourself. It's very difficult to transfer businesses in a real distinct, orderly fashion if you have a sole proprietorship. But when you own a corporation, how do you in fact own a corporation? That's exactly right. You own that in shares. So the transferability of a company comes by the buying and selling of shares. Got it? Now, there are different kinds of shares, and we normally see this a little bit more clearly when you talk again about big companies, but you can do it again on the smaller ones as well. You have preferred shares and common shares. Now, the difference between the two is that preferred shareholders get preferred treatment. I don't know how to say it better than that. In other words, if a company doesn't do real well in making a lot of profits, who gets paid the profits first in the form of dividends? Preferred. If a company goes bankrupt and they have to liquidate the assets, who gets the payments first? The proceeds. If they're not enough to go around very good, who get the preferreds? So that's correct. And the common, of course, they get the benefit, though, that in general, the common shareholders, if a company does well, get paid better. They're not in quite as safe a position if, you know, everything hits the fan, but nonetheless, they get that. So how do we have control of a company then? Control comes to do with the difference between voting shares and non-voting shares. Now, generally speaking, when you have publicly traded companies, because they are publicly traded, most all of the outstanding shares are what kind of shares? Voting shares. The outstanding shares that are already owned and issued by the company, they're owned by the general public, and so those are voting shares. And the reason, of course, is because they want to make sure that it's fair to everybody, that if you got your own dollar if you got your own dog in the game, you know, your own money in the game, you should have some sort of say for every share you own. You should have a vote on how the company runs. But when you're talking about privately owned shares, you have control over how those shares are issued. Now, it makes sense that if you have a privately owned corporation, is it possible that the voting shares may actually be a very small percentage? Remember the very first, yesterday morning, one of the first examples we put on the board was about that $10 million corporation that you started. You started out with zero, now it's worth $10 million. And we told you about the principle that says you don't have to own it all to control it all. And you only own 1% of the shares, but that's the voting shares, and the other 99% was the non-voting shares. But as a result of you owning the 1%, do you basically control the company? Has nothing to do with how much of the company you own, of all the shares. It has to do with who controls it. So this is why it's important to understand that. Now, you need to realize that part of the problem that's associated with that is if you get sued, and I noticed that Clint was mentioning this to you yesterday morning. Let's say that going back to Rick owns all the shares for IBM. He's very rich. He gets into the mother of all lawsuits. A judgment is brought against him. And it just so turns out to be that the judgment is for more than the insurance that Rick has. Could the creditors go to the judge and say, Judge, this guy is rich beyond you cannot believe. He has a judgment against him. His insurance is not enough to pay the bill, but we know that he owns all these shares of IBM. We request the court require Rick to liquidate his asset or his shares, or at least to transfer the shares over to us as part of the judgment. Is the judge going to do that? Count on it. It will happen. Yes, it will, because it's part of his assets. And because he owns the shares and he has a judgment against him that's greater than his insurance, they will require you start liquidating your assets, and your assets are including your shares. That's why it says on here, problem, creditors gaining control of shares. Do you understand that? So there are things that we need to do to protect that. Now let me throw something out at you that you don't understand yet, or at least some of you don't, but you're going to get it later. How about having your shares, instead of Rick owning them personally, have them in a limited liability company or a limited partnership where the lawsuit can't break through and take them? That's a great strategy. I like it. I have a corporation that's used for training, and because I like to fly, I have a little flying aircraft that I use. And so when I started out the corporation that does the training, does it make sense that if it's going to be training in aircraft, that perhaps maybe it ought to own an aircraft? Okay, but is it possible that the mother of all lawsuits could come against me? Maybe I might get into a traffic accident and kill somebody, and because I own all the shares of that corporation, could they liquidate the shares of the corporation and all of a sudden walk away with the corporation, my aircraft, and all kinds of weird things? So I did two things. Number one, there's a subsidiary of that corporation that's an LLC, and that LLC is the one that owns that aircraft. And therefore, it's protected against the LLC, the limited liability company, is protected separately from the corporation. And then we did one more thing. We put the shares of that corporation into another LLC to make it so that if I get sued, they can't touch access to the shares in the first place. Now, in the process of doing all this, are we using more than one entity? Do you see the benefit? Why do I have that C corporation in the first place? Because I love the perks, man. I'm telling you. This is such a great tool because that corporation buys my medical insurance plan on me and my family and I. It does all kinds of things. It provides perks and benefits. So is this corporation the greatest tax shelter in America? But does it have some inherent flaws if I own the shares all by myself and I get into a lawsuit? So I had to incorporate some of the other principles that we're learning in here, like lawsuit protection, to protect that corporation from being able to have somebody take it away from me in the event of a lawsuit. And every one of you are going to understand that as basic 101 kindergarten stuff by the time tomorrow night's finished. You're going to understand that. This is basic 101. So I'm just saying, understand how the structure works, where its strengths are, where its negatives are, and that there are solutions to solve the problems. In other words, we don't throw the baby out with the bath. Just because the baby's dirty and has bath water dirty, we don't throw the baby away. The same here. We don't eliminate the corporation just because somebody might be able to take it away from you. We figure out the problem and solve it. All right, let's talk about liability issues. In theory, there is a thing called a corporate shield. Some of you have heard the term but don't know what it means. Yesterday morning, Clint told you that one of the benefits, and I've referred to it several times, one of the benefits of a corporation is that it makes a lousy lawsuit protection device as far as protecting assets from being taken. We've already shown how that happens. But in theory, if the corporation gets sued, they can't come after you as the officer or the director. Right? Are you with me? So that corporate barrier between a lawsuit against the corporation not also going against you is known as the corporate shield. That's the idea. The corporate shield. Now, let's see. You know what? See this? This is my box of all these pens. Do you notice they're all here? You've been good boys and girls. Nobody's going to sleep, at least that I've seen. So you're doing good. However, this corporate shield is only as good as the state statute that wrote it. Some states have a better corporate shield than others, and we're going to talk a little bit about that right now. Most states have a statute that says that you are protected as an officer or a director from personal lawsuits that were started through the company, so long as that it cannot be shown that you were negligent. What does that mean? Well, as we've entered more and more into a lawsuit epidemic over the last 20 years, that corporate shield is almost invisible. It's gotten worse and worse and worse. Trial attorneys have taken these things to court, and now they're showing that when somebody made a bad decision at the corporation that day that led to massive lawsuits, what caused that to occur was not just a corporate decision, it was that officer who was negligent in their duties. The judge says, how was this person negligent? Judge, we'd like to now be able to prove that on that morning, this officer got up in the morning and he severely stubbed their toe on the bedpost. I mean, that toe was so sore, it was bleeding, the toenail was all sore, and yet this person had the audacity to go to work anyway. They should have known that because of that pain and suffering, they were going to be clouded in their decisions, and therefore they made that decision because they were negligent and came to work that day with the... Do you hear my point? That's how insane it's gotten. So I know that my good friend associate Mr. Jay Minton has said for a long time that the corporate shield when it comes to protecting officers and directors from personal lawsuits is about a C+ at best. It may be an A++ rated tool for for tax shelter reduction, tax reduction, but it's a lousy tool, not just for lawsuits against assets, but even against you being protected. So that's one thing. Now, remember I told you a little earlier, I might as well just tell you this real quick. Remember we told you earlier that one of the things about Nevada is that they have state statutes showing that maybe there are benefits in that state that you don't get from other states. Well, here's one of them, and I'll make reference to it again in a few minutes, but this is a good time to bring it out. One of the benefits about Nevada is that they say that there is a corporate shield, but it says that if the corporation finds itself in a massive lawsuit, and the attorneys are considering going after the officers and directors for negligence, that will not be sufficient to hold the officers and directors personally liable. Why? Because in that state, it says that they have to be proven to be grossly negligent. And the answer is, well, what does that mean? And my answer to that is, well, I don't know what that means, but it's sure a whole lot better off than being negligent. So, whatever they're going to have against me, I want to be in a state where I have to be proven to be grossly negligent instead of just negligent. You got my point? But that gives you an idea about, again, the differences between the states, and we'll talk a little bit more about that. By the way, can you remember what's happened here recently? How many remember the Exxon Valdez thing up in Alaska? I have some kids living up there, so I know that affected that up there. And its effect there has been felt for decades now. That was one of the greatest environmental disasters until the BP disaster down here in the Gulf here kind of recently. But it's interesting that the corporate shield was broken and they went through after the captain personally. Why? He was drunk. That is exactly right. He was grossly negligent. I mean, in every respect, it was negligence to a to a criminal degree. So the corporate shield works as long as you keep things legal. Shareholders are protected. You know, to this day, one of the greatest shareholder disasters or corporate disasters as far as human life is concerned happened about the same time as the Valdez, I guess. I can't remember. Time just has a way of flying. Does everybody remember a little company called Union Carbide? And they had a little incident that occurred over in Bhopal, India. Somebody left, you know, it's a chemical manufacturing plant, somebody left the wrong valve open and they flat dead killed about 10,000 people. You know, massive lawsuits. Yeah. How many shareholders suffered personal liability as a result of that? All of them. I know this is a trick question. Actually, the reason why they all suffered personal liability is because you know what happened to the value of their shares the next day? Right. So did they take a personal hit? Yeah, they did. Everybody suffered personal liability on that. But why I said personal liability was after the value of the shares went down, how many of those shareholders had personal lawsuits against them personally because they were shareholders in the company? Zippo. Zip, zero, nada. You see, that's why people invest in corporations in the United States of America. That's how we inspire new development, growth, entrepreneurialism, because we know that shareholders can actually invest in corporations in America, and if something really goes bad, they're not going to be held personally liable. If there's something that's really done bad, maybe the officers and directors might be liable, but certainly not the shareholders. So these are reasons why you have to understand how this works. All right, so we have limited liability there. But one of the greatest reasons, of course, for having a corporation is the benefit of understanding the power of having the greatest tax shelter in America. Now, this slide over here on the left represents the kinds of tax deductions or the types of tax benefits that you might expect literally right within the confines of the corporation itself. Most of the items that you see over on the left-hand side of the page are items that would have been included in Section 162 of the Internal Revenue Code. There's a whole lot of examples in Section 162 of the kinds of things that you might want to consider taking as a tax deduction the next time you have a board of directors meetings or a shareholders meeting. This is like having a huge menu in front of you. You know, when you have your board of directors meeting, well, let's see, let's look at the list of all the kind of tax advantages we might get from our corporation. Which one are we going to have today? It's like lunch, you know. The problem with most all of you is that you don't have that list in front of you, and therefore you do a lousy, lousy, lousy job of taking anywhere near close to what you could be or should be doing with your corporation. I talk to groups all across the country that think they're in the business that they started the business out for. What kind of a business are you in? I'm in the dental business. What kind of a business are you in? I'm in the cattleman business. What kind of a business are you in? I'm in the, the bug spray. What do they call that? Extermination business or whatever. No, you're not. You're in the tax shelter business. Tax reduction business. Every one of those businesses has by the tail one of the greatest tax shelters in America. And they're doing a dismal, dismal job of coming anywhere close to being able to take advantage of it because they don't know what the menu is in front of them of all the different tax deductions. Let me carry this example a little further just to drive this point home so you got it. What would happen if you went out to a restaurant? And this is a weird restaurant. This is the weirdest restaurant you've ever been to. Here's why. When you sit down in the booth that the host or the hostess takes you to, you just happen to notice they didn't give you a menu. And then the waiter or the waitress comes over and says, you know, they got their little pen and their pad. They say, "Hi, folks, what can we get for you today?" And you look at them a little sarcastically, a little condescending. You say, "You know what? They didn't even give us a menu like we know what we want." And the waiter or the waitress says, "Oh, I'm sorry, didn't they tell you? We don't have menus here at this restaurant." And you look a little surprised and say, "You're kidding, right?" "No, we don't have menus here." And then you're going to say, I've never been to a restaurant that didn't have menus. Well, this is it. We don't have menus here. You just tell us what you want. We'll see if we got it. Well, I don't know what I want. Well, I'm sorry then. What do you want me to do? We don't have menus here. You just tell us what you want. So then you get real creative. Do you have hamburgers? Oh, yes, of course we have hamburgers. Would you like a shake with that? How about fries? Yeah, I'd like that. And then you're sitting here thinking, gosh, you know what? I might have ordered something beside a hamburger and fries if I'd had a menu in front of me. Are you getting my point? That's how you're running your corporation. When people hold their board of directors meetings all across this country, if I walked in and I says, can I see your menu of all the tax deductions that you should be considering taking for your board of directors meeting this month? Well, we don't know what you're talking about. Oh, really? Well, how do you know what deductions to take? Oh, we got the same stuff that we always use. You know, the hamburger and fries thing, salaries, you know, you got a few business expenses that are so obvious they're just night and day. But what about all the good things that really would juice it up? What about the kind of deductions that might be the, you know, the steak and lobster, you know, whatever? You're missing out on them, class, because you don't have that menu in front of you. So that's why you really got to get more familiar with what happens in Section 162. And by the way, I think they have a publication called Fringe Benefits of Owning Your Own Company or something like that. You have the internet. This is not secret. Go there and have it give you a list. There are about 300 different items they list there as suggestions that you might want to take the next time you have a board of directors meetings, and I'll bet there's some things you should be taking you hadn't even thought about. I think I made my point. Thank you for letting me get a little drink. So these are the kinds of things. All right, well, let's talk about these. The power of a corporation, then, is the fact that it has the ability to pay thousands of dollars worth of benefits to a little person called you. And any time that benefits are paid out by corporations, I have a nickname for it. They're called perks. Everybody knows that corporations pay out perks to their officers and directors, etc., etc. But we also know that the stuff over on the right-hand side of the page, well, that has to do with why you came to class. This has to do with other entities that you might consider setting up that does business with the corporation. So there are a lot of tax benefits that you might get right within the corporation itself, and then there's a lot of interesting benefits that you get by having it have associations with other entities. For example, look down here in this little S corporation. What does it say? 100% owned by what? Your children. What if this little S corporation down here has an agreement with your corporation to do marketing and you know, maybe it's got an agreement to do marketing and promotion. Well, what is marketing and promotion? Well, this little corporation down here that's primarily owned by your kids, boy, they're expensive. Man, they've got this agreement to do marketing and promotion for your company. Boy, they're sure expensive. You know what they do? All your little kids sit in front of the table and they got all these little brochures and they lick them and they seal them and lick them and seal them and so on. And you send out these things, they put stamps on them and so forth, you know. Well, is that marketing and promotion? Yes. And you know what? You'd be surprised that for the age of these kids, how much that corporation charges your corporation for doing that. So when your corporation pays those expenses over here to these little kids over here for doing this business, is that shifting money out of this business and moving it over into this corporation? Shall I tell you something a little interesting? This corporation over here is in Ohio. That's a very high tax state on all the profits, but this one over here is in Nevada, and it doesn't have any income taxes. Do you see where I'm going with this? Can you have relationships with other entities that might help you accomplish some of your goals, and in the process of doing that becomes part of this tax reduction strategy? This little one I have up here on the top. Some of you might actually have elderly parents that you're taking care of. I'm only using this as an example. And sometimes they have their own money and sometimes they don't. Sometimes it's just worked out to where they spend all their money on you, and now you're doing pretty good. They haven't got anything left, so you're taking care of them. But in many cases, is it possible you might be spending money on their care with after-tax dollars that you paid out of your own business? You already pay taxes on it. That's an expensive way to do it. Could it be possible that even though they're elderly, you might be able to put them on the salary for your business? Give them a wage, give them a salary, let them do something. And now when your company pays wages to them, is that a tax deduction to your corporation? Are they now going to be taxed at their tax bracket instead of your tax bracket? Yes, you see that? And by the way, could you also, how about your children? Do you think you could hire your kids? At what age has the IRS already gone on record for to show that you could hire your children and have it be considered as a legitimate business expense of the corporation to hire your children? At what is the minimum age the IRS has already gone record for you to be able to do that? 7 years of age. And I remember the first time I heard that years ago, I thought, you're kidding me. Man, I can't even get my 14-year-old to do anything, let alone 7-year-old. Then we started having multiple children. You know, have you got more than one kid? Are you kidding? You know what my wife found out? The 7-year-old will work the socks off the 14-year-old. I'd rather hire a 7-year-old any day than a 14-year-old. Huh? We got 30 grandkids, yeah. You know what? These kids, are the little 7-year-olds, man, they're so excited to help out in the business. They're willing to do anything. I mean, they'll climb trees for you for that price if you want to. I mean, they're really great. They'll clean out all the garbage cans and they'll take things out. And, you know, you don't even have to pay them a whole lot either. But let me tell you, what if you paid a 7-year-old a wage? Can they put up to a certain amount in their wages into a Roth IRA? At what age? 7 years of age. Can you imagine how much money they will have down the road if they... You talk about the principle of compound interest. Man, they got all kinds of time to be able to do that. Wow. So I'm just saying, be a little bit creative and do some fun things here, and I think you might see how that might work out.